Hey everyone, welcome to Monetary Minds, the podcast where we dive deep into the crucial questions and challenges facing central banks and the global economy today. I'm your host, Joeri Schasfoort, ex-economics lecturer and founder of the online economics outlet Money Macro Media. And today I'm joined by Doug Laxton, who is an ex-Bank of Canada economist, ex-IMF economist, and now is with the Better Policy Project, and will talk to us about the inflationary consequences of the new US tariffs inside the US, so for the Federal Reserve. And for this, we'll be using the FPAS Mark II framework, where we work with scenarios. Specifically, scenario A, inflation will be higher than market expectations. Scenario B, inflation will be lower than market expectations. And perhaps also some extreme case scenarios, which we might call scenario X or scenario Y. Doug, to start, a lot has happened. Trump announced huge tariffs on the world and has now said, look, there's going to be a reprieve for everyone except for China. There's going to be even bigger tariffs on China. But still, 10% tariff on every country in the world is quite a lot. So how should we think about the inflationary consequences of all of this, Doug?
Okay, very, very good question. So my students at the Global Forecasting School are taught to take different approaches to answering that question. One approach, which we're publishing in the Oxford Journal of Economic Policy, are models that involve endogenous monetary policy credibility. So that's about the macro implications. But before we get there, we have to first understand what the microeconomic implications of these tariffs are. So what we use there is basically input-output tables to trace through how, for example, if you put a tariff of 25% on steel, how that cost is then passed on to all the things that use steel in the process of producing goods and services and so on. So we have estimates of that, and then of course we have estimates of how that then feeds in to the goods and services that are consumed by the household sector or by the business sector or by the government and so on. So this is, something that my work started many decades ago when we developed this kind of framework at the Bank of Canada. And luckily, it is actually followed now at the Fed. So the Federal Reserve Bank of Boston published a nice little paper that basically has these estimates in it, so anyone can do these calculations once they make some assumptions about what the effects of the tariffs will be on the prices of either intermediate inputs or final inputs. My students have been going through all of that independently, I might add, and on the basis of the tariffs that were announced before the reciprocal tariffs were taken off yesterday. So now the reciprocal are just flat 10% on everybody and stuff. But before that happened, they had estimated that would affect the U.S. price level, CPI, by 2%. So this is a level effect and so on. Now, the PCE, consumer goods, will change by less than that, because as people substitute away from iPhones, which are going to get really expensive from China, towards maybe Samsungs, which only are subjected to this 10% tariff, then obviously the weights in the consumption basket will change. So the CPI will actually overestimate inflation. But how big could it get? Somewhere on an annualized basis in the second quarter. So this is Q on Q annualized. the inflation rate for the CPI could be between 4 or 5%. And then, so if that were to happen, well, second question. So what happened last night with the revisions in tariffs? Well, they took the really high tariffs off most of the countries and just made it a 10% reciprocal tariff, but then imposed a whopping 125% tariff on China. So what did that do to the inflation numbers? Nothing. And there's like two offsetting effects. And so we could still end up with 4 or 5 percentage points, like 4 or 5% annualized inflation in the second quarter of this year. That could start feeding through in April, May, and June. And if that happens, that will likely put the Fed in a very, very difficult situation, because it's also just as likely on the basis of the recent numbers. So the February retail trade numbers, they have all been very weak. Consumer confidence has been weak. Usually consumer confidence numbers are meaningless, but when they happen at the same time, that you start to get hard data that households are restricting their consumption purposes. If you look at JP Morgan, they've increased their probability of recession this year, not over the next year, but this year, from 40% to 60%. And they, in an interview, Jamie Dimon indicated that they're seeing anecdotal information from CEOs that things are slowing down and so on. So yes, the probability of recession has increased, and you have this inflation surge because of so that's going to put the Fed in a very difficult situation. But these are the kinds of shocks that truly test strong institutions, because they have to manage the inflationary consequences and, of course, the implications of their dual mandate of full employment and so on. So that's kind of where things stand. Big issue, which I think Charles Goodhart pointed out in an earlier session, is that could put pressure on central bank independence. Term premium on longer term bonds could ratchet up quickly, and this, of course, could push us towards that critical threshold where there is a fiscal crisis. So Ray Dalio, who was in Washington a couple of weeks ago, was warning about the debt situation and so on, the fact that the debt dynamics are not stable at higher interest rates. And so we could have a situation where bond vigilantes demand much higher term premium, and that's going to put the Fed in a really difficult position, because do they try to promise a low path for the Fed funds rate, through monetization and stuff? And so, this is not. These are not scenarios, so that would be like a case A scenario where interest rates had to be higher, but the economy was going into a recession. And the problem is that if you didn't raise the interest rate, you might end up with even higher interest rates and dealing with a much bigger inflationary problem down the road. Effectively like a stagflation, something of the order like we observed during the Great Inflation in the 1970s. There's something else that is worrisome about this, and that is the dynamic. Okay, we're now in a internet revolution. Things are much different in the 1970s. And the big question is, will things happen faster than they happened in the 1970s? Because, already There's indicators that, people are very concerned about inflation. Well, people start to raise prices faster for two reasons. One is that it's on the heels of the COVID inflation, where people, fell behind because they didn't raise their prices or their wages fast enough to keep up. But the second one is that it's so visible that something like an increase in tariff seems like a pretty justifiable reason for raising your price, and so that, but as you say, nobody knows what's going to happen. The tariffs on China of 125%, that is going to change the market massively, and so we're best not to have too much confidence in what our forecasts are, and be watching these things very closely to see how the situation develops over time.
Yeah, and Doug, if we use the FPAS Mark II framework, so look, we first would look at market expectations, right? So what are your thoughts on what market expectations are roughly now for inflation and interest rates?
Oh, so yesterday when the market closed, they were expecting 2 or 3 cuts over the next year. They're factoring in, effectively, it's not a recession. It's not even a recession yet, because if you look at all the data in financial markets that would be consistent with a recession, we're not there yet. Okay, so like things like the BAA spread has gotten up to 2. Okay, so it looks like a little bit of worry about inflation on the basis of that, but that it should be 3 or 4 if financial markets truly thought that there was a recession around the corner and so on. So, but people are concerned in financial markets, and when they're concerned, interest rates, 2-year interest rates will go down in line with the impact of the Fed funds rate is based on their dual mandate of full employment and price stability, meaning 2% inflation in terms of the PCE. So what's really interesting when you have these stagflationary shocks is that you truly get to see how the central bank is managing the short-run output inflation trade-off and so on. So this is where Mark II, is designed. Our analytical framework actually uses the same analytical tools. Bob Tetlow, who's one of the guys at the Federal Reserve Board that runs their analytical work there, the same analytical work that when you look at with a 5-year lag looks very much like the foundations of FPAS Mark II, but they only publish it with 5-year lag. But what he said at a recent conference in Georgia was that we are the only guys in the world that think about these problems as mixed complementarity problems, where you actually have an objective function and not some Taylor rule, but some objective function that has output and inflation, where you explicitly are thinking about managing the trade-offs in situations like today. So it really comes down to this. So we produce a case A. Case A scenario is going to have inflation that's higher than what is priced in financial markets. Okay, so if we think about what's priced in financial markets, that might be a number like about 4%. Okay, like I'm talking about 4% in terms of where people think prices are going to go in the second quarter of this year in response to the higher tariff. So a case
So
A,
that's higher than that's much higher than 4% annual inflation. Then that's just
yeah,
purely
well, no,
quarterly.
4% annualized. Sorry,
Oh, okay.
4%
Okay.
annualized. Okay, so you have to divide it by four, so that would be
Yeah.
like
But I think it's already
one
interesting
percent
there
higher. So on the
that
year on year, that would be taking the year on year up, okay, by by a percentage point. Okay, um, so that'd be quite significant. So if you thought we were at 3, it would take us up to 4. Okay, and that would be quite significant. Case A would be higher than that. Okay, and so that would be, but inside the, what we would describe as a market reference scenario is that people would think that that increase in prices in the second quarter would not be would not, it would be a level effect, okay, that the Fed would respond to, that there would be no upward shift in inflation expectations. So that would be like what would be
transitory, right?
with a market reference. Pardon?
Transitory
Yeah,
inflation. Yeah.
transitory. Transitory. That's right. So
Yeah.
transitory. Now, of course, the Fed, has already remarked in its minutes that it's, not going to be fooled by that transitory game again. That they are concerned that it could be more persistent with that. So that would be a scenario where it turns out to be higher than that and more persistent, and then of course that would require higher interest rates, and that's what we would describe as a case A scenario. Now, our case B scenario, unfortunately, isn't that great because the case B scenario is usually because of a collapse in confidence and a recession starting, and it's very easy to build the logical case for that recession. I mean, on the basis of GDP now estimates, GDP probably contracted 1% in the first quarter, and if you look at the available indicators, both hard and soft data, I mean that they're not inconsistent with us actually observing either a conventional recession of 2 consecutive quarters where there's contractions, or a growth recession where GDP is substantially below potential, and so on. So that we think there's very good reason, so we buy the argument that we're probably entering a recession. But what's worse than that, we're going to be entering this recession where inflation is going to be rising. And that is going to put the Fed in a very difficult situation because, are they going to wait and see if these inflationary surges are persistent, and are they going to start cutting rates quickly? And that really depends. That's the board's decision to make about how they weigh the objectives of inflation deviating from the 2% target and unemployment and so on. So it's going to be a very interesting period, I think, for them to manage their way through this. Especially given the potential conflict between the administration and the Fed and so on. There are other things going on here too that make the problem much worse than just tariffs, and that is fiscal policy is still expansionary. Case B scenario would be one where they wake up and realize that they have to do something about the deficit, and that could result in very persistent contractionary forces over a number of years. So that'd be another kind of case B scenario where we kind of work our way out of this crisis, but in a way where, I don't think people would be too happy about the outcomes, because we'd have lower growth, higher inflation, and of course it would to a large extent be totally self-inflicted. And so there's going to be issues about why that happened. Okay, but
and Doug, do you also look at a case X scenario?
so case X is really easy. So case A is one where you have these inflationary forces, okay, and they end up being higher than what people expect. And you could say, well, again, that's because they're in an inflationary environment. There's econometric evidence and good theoretical evidence that the Phillips curve is convex. Okay, so that would be very much consistent with what we know about inflation. But more importantly, we know that central bank independence is by far the most important variable that determines things like term premium on longer term bonds and country risk premium. Okay, now of course in the U.S. Because of the reserve currency status, they seem to have broken all the empirical laws, the econometric laws. But the question is, I think a better way to put it is that if you keep pushing it, you push your debt to GDP ratio up to unsustainable levels. At some point, the logic becomes incontrovertible. Okay, don't know if everybody understands what that means, but it means that you can't deny it that interest payments depend on the stock of debt, and when you end up with more and more debt, you get into a situation where you can't have the interest rate rise because you can't pay the interest payments on the debt. It's that simple. That's why I mean the logic is incontrovertible. And so if you buy that, then you have to be really, really concerned about interest rates rising, or environments where interest rates can rise, such as an inflationary environment, or a situation where central bank independence is attacked, in which case, in modern financial systems, investors will leave that market. The market will disappear, or the way we think about it in the short run is that the term premium and longer term bonds will rise, or the country risk premium will rise. Okay, so that would be a really good case X scenario. You might even call it a triple X, because it would mean almost certainly a fiscal crisis in the U.S. and all the other countries that have debt, and that would almost certainly mean a global financial crisis instantaneously. There would be no lags, because out of this whole process of dealing with the global financial crisis, there's been all this unconventional monetary policy, and it's involved banks putting tremendous amounts of treasuries on their balance sheets, and of course there was even regulation suggesting these were risk-free. So unfortunately, what we've shown through economic mismanagement is that the government debt is not risk-free. It potentially is very risky. We've always known that in small countries, and this is what effectively constrains small countries from doing crazy fiscal policies and monetizing and so on. But the idea that bigger countries like the U.S. and the Euro area and Japan, that they could monetize, and of course, so that door has been open. So that's the real triple X, kind of scenario out there. And
Yeah,
unfortunately, as Ray Dalio thinks that
this could happen.
that is within the next 3 years, and I agree with him about that. But if it doesn't happen, that's a probabilistic statement. If it doesn't happen in the next 3 years, if we go into an environment, for example, a case B, where we go into a recession, a global recession, what Charles Goodhart was talking about, and we go back to the effect of lower bound on interest rates, then that's not so good as well, because how do we deal with that? Well, we deal with it with expansionary fiscal and monetization, and there's no question that we can get inflation up. But the problem is that if it has unintended consequences, that asset prices continue to get higher, in other words, bigger bubbles emerge, or if it is associated with, which it almost certainly would be, higher levels of debt, it means that down the road we then face a lower threshold for the interest rate, where Ray Dalio's argument and my argument about debt sustainability doesn't hold. So we might cycle. We might go there, crash, or interest rates might go down. We would get more debt, and that's going to then compress the corridor, and then we'll crash. So that's your, you can arrange these scenarios. The first one would be triple X, where we'd have a fiscal crisis and a financial crisis within the next 3 years because of a market reaction. The second would be global recession, taking us back to the effect of lower bound. We make the same mistakes as we made before. We end up with higher levels of debt and asset prices, and then that, of course, shrinks the corridor and shrinks the upper bound that interest rates can go to without igniting a fiscal crisis and a global financial crisis. So that's kind of a short menu of some of the case A, B, and X scenarios that we think about.
Yeah. Do you also see a scenario where we get just going back to the lower bound, and then that it really sort of escalates into a great financial crisis type of scenario, where I would guess maybe the housing market is not going to be so much of the conduit for that, but rather it might be that there's a bubble in equity markets. This causes the US economy to really go into a very sharp recession, amplified by the fact that uncertainty is so high, and that therefore the investments are not made at all. And then you basically get what you mentioned as the case B scenario, but on steroids.
So the reason I'm not worried about the effect of lower bound resulting in a Great Depression and so on is that central banks can monetize. Okay, so you don't have to worry about this whole issue.
But they don't always do that, right? Like with, of course, with the Great Recession, in the US they did it more. Well, I'm not sure if you could call it monetized, but they did stimulate more than in Europe. But who knows? Now the administration is thinking we're already too much in debt, so we cannot. Could that happen? That they still say that they are very fiscally conservative.
No, even the Germans have given up on their no.
No, okay.
No,
I'm just seeing where I can push it.
We're imagining something where there's enough pain, okay, where
Yeah.
all they need to do is pull the trigger. Okay, so think about Europe, the euro area, right? Draghi during the European debt crisis said, "We'll do whatever it takes." Okay, and that meant monetization. Okay, and so think about, there was that much pain during the European debt crisis to get people politically aligned to create enough fear of something really bad happening. So that's why I don't fear like a big depression. You're absolutely right that it could take a bit of pain
Yeah.
to get to that point. Okay, and so I'm totally,
Do
I'm
you
totally
think the
on board.
politicians have learned by now? Look, we're not going to allow it anymore. Yeah. No, that makes sense. I think it makes sense. Yeah.
But the economics, that's an argument about the economics, because the economics is so powerful because they have that instrument. But the problem is that once you let the instrument out of the bag, how do you put it back in the bag? And that's where that's the problem, because if you get in a situation where you have too much inflation in your economy, you have to raise interest rates to deal with it. And the problem with that is that once people recognize that, then there can be this tension between the central bank and obviously the political authorities and so on. So it's this monetization is a dangerous thing because it works so well in certain situations, but the problem is that once you pull it out to do that, it means that you lose the discipline on fiscal policy, because they can always come back to you and say, hey, you guys can solve the problem quite easily. We don't have to raise taxes and so on. So this is fundamentally what the problem is. So that's why I'm worried more, even though we've had a history. So we used to have a lot of inflation. That's when I grew up. And then we brought it down. And it's been, very stable and low. And then we have, COVID, a little bit of inflation now. But the question is, where are we going? Are we going back into the low and stable inflation world? Or are we going into a world? Actually, we're just publishing a book, hopefully soon, called Scarcity and Uncertainty with Bill White. And hopefully, we'll be able to explain what the basic arguments of that are. But I've tried to summarize them a little bit. This kind of corridor theory for interest rates plays into it. But some of these more fundamental arguments about what causes the asymmetries in the process of, should you be more worried about deflations? The Fed, actually, if you look at all the FOMC members, they're all Great Depression experts. That's one of the characteristics that I kind of like about the Fed. But I wish there were there was more expertise about inflation than the Great Depression. But the Great Depression is really emphasized in the way things are taught in U.S. Academia and in policymaking circles. And it's embedded, of course, into congressional law, the dual mandate of full employment and inflation. The last minutes, everyone should read, the ones from March, went on forever about what what did the dual mandate actually mean. So they reaffirmed the idea that it would be nonsensical to have a specific target for anything, that you needed to monitor many different indicators like unemployment and vacancies and labor force participation and everything, and formulate some sort of assessment about what you thought was full employment. And so this, when you think about full employment as being a malleable concept, this will also come into play, Joeri, when you as they manage these trade-offs going forward. These things will really be affected because you'll have a slowdown in labor supply, okay, because of immigration and so on. You'll also have worse matching because one of the advantages of getting labor from Latin America is you could get the labor where you need it. A lot of the labor I would describe would be, pardon the expression, but jobs that were dirty jobs, jobs that, high wage.
Yeah. That Americans didn't want to do, right?
Yeah. So there's, there could be disruption to the labor market in the sense that they can't get the right kind of labor to the right kind of place, and that would rise. The natural rate of unemployment could rise substantially. And does the Fed recognize that early enough, or do they make the same kind of mistakes that they made in the past when things like that have happened, like in the late 60s and 1970s? Kind of similarities.
So one thing that I haven't heard you talked about yet is the administration seems to think that regulation is a very big issue in the United States. That this is really holding a lot of companies back. And the stuff they cite is they would say, like, look at Republican states where you have seen much more factories being built than in Democratic states where it's just very difficult to build. And they also talk about how there's so much waste in the government. Let's do this first. I'll give you another argument second. So there, and then specifically in banking, now Scott Bessent, the new Treasury Secretary, he is talking about huge deregulation, unleashing credit again. Do you think this, is a credible argument? Is regulation really holding back business that much in the U.S. these days? And then maybe also in the financial sector. Could that contribute to a case, a scenario where we get a resurgence in sort of local economic activity?
Sorry, I have to take a breath to answer that question, Joeri, because I cannot disagree more. Okay, because but let me explain to you what my bias is and so on. We had during COVID, during the first quarter of 2020, when equity prices fell by about 30%. Okay, and you think, well, that makes sense because there's massive uncertainty and we're producing less output. Then, after that, with these incredibly stimulatory policies, both fiscal and monetization, and I don't mean printing money. I mean monetization. To read about there's all this crazy stuff about people talking about printing money, but there's something similar in the real world that works. That's called monetization and so on. And the combination of this massive fiscal and monetization resulted in over a 50 trillion increase in U.S. household assets. And so this is the combination of equities and housing and bonds. Okay, but principally the thing that would have been driving it was a massive bubble in equity prices, where the NASDAQ more than doubled and so on. Okay, so this, I think, explains in our econometric work with one of my co-authors, Miriam, this explains why we haven't had a recession that everybody has been predicting over the last few years, because basically they've got so much wealth and liquidity in the system right now. Okay, now of course, when you understand how endogenous money creation works, that can go in reverse. So, for example, I'm waiting anxiously for the May Senior Loan Officer Survey, which the Fed will get to see before they make their May decision, because I want to see, are they tightening credit standards on the riskier customers in the distribution, so households and businesses and so on. Because if they are, that will tell me whether or not a recession is underway, or whether or not it's going to be delayed possibly until later in the year and so on. So, we've got this tremendous bubble. Okay, so how could this bubble in equity prices and property prices, what could happen with that? Well, it could be consumed. Of course. In other words, if it persists, then it will support consumption, and consumption will also support housing. So housing typically is what we call an income elastic or a wealth elastic good, which means that its demand will go up, which means that this asset price bubble will translate at some point into higher leverage. And when you have higher leverage and an asset price bubble, that is the seed of a financial crisis, big financial crisis, big bubbles, and of course excessive leverage. In other words, people taking out loans based on totally excessively optimistic expectations about the future, or underpricing of risk in the world. So no, I don't think now is the time to be talking about deregulating the financial system. I would start with the opposite. I would be making sure that the financial system is being properly regulated, because I do not believe that it has been. That's why we're into this situation that we're in. I need to see, more, bringing Mark II to financial stability. Instead of, reading the financial stability reports that are put out by the U.S., every January, and where you see these, this marginal thing happened in the economy, and so the assessment changed marginally by this amount. Without some really fundamental reassessments, assessments that require, for example, scenarios with higher interest rates. Like, why are they not considering in their financial stability reports the exact scenarios that people like Charles Goodhart and I are talking about? Because is it because they realize that it just doesn't add up, it just adds up and points to a crisis? Now, you might have, philosophically, you might say that I'm old-fashioned and too conservative and so on. But you might say, okay, we just need to loosen the rules and regulation, cut taxes, and we're going to grow out of this. Okay, that American dynamism, is what you should believe in. But let me put it this way: if you're not an American, I would be wary about the implications of that kind of faith that somehow this is all going to work out, just by less regulation and lower taxes. But it could happen. It doesn't seem very likely, but
Yeah,
good
look,
question.
I think what he means is, well, sorry. Part of what I hear you talking about is sort of the financialization of the U.S. economy that has happened, for a very, very long time now. And that is something that Mr. Besant sort of doesn't like. So what he's really talking about is like deregulating smaller banks. And then I think what he has in mind is, but obviously It's very unclear if that's actually going to happen. But I think what he has in mind is like, we're going to build all of these new factories in the US. For that, you need a lot of credit. And then you could potentially see that you deregulate, because deregulation is often very vague, right? What do you mean deregulate? There's so many ways to deregulate, but I'm just steel manning his case. So I'm just taking the best sort of possible interpretation, even though he didn't say that. Would be, look, we are going to make building in this country much easier, and that means building houses, and that means building factories. Then we're going to deregulate the small banks in such a way that they can facilitate mortgages for building houses, perhaps small loans for construction companies, and loans for factories. But not what they used to do, which is sort of a lot of loans for financial speculation. Now, of course, I made a ton of assumptions already there, but that's sort of my super positive interpretation of what he's talking about. Yeah. Look, maybe I'm also asking you a little bit of a naive question. Like, do you think that can work? We'll have to see, I guess, right?
I think it's an extremely complicated question that I would not want to even answer that question without first starting off with a macroprudential framework. Okay, and I couldn't begin to answer that question because I need to have a macroprudential framework to help me understand what are the key macro risks in the financial system, and how should I think about big banks and small banks and so on. So that is far too difficult of a question to answer, I think, in this interview. Okay,
no, it's also something that I do not know. Like, this is something, for this you need to have really detailed knowledge of exactly the problems in industrial markets in the US, house building, in small banks rather than big banks. Yeah, no. Maybe something interesting, though, to end our conversation on. I think we've discussed now in length the case A, case B. We've discussed triple X scenario. And we've discussed some of the intentions of the current administration. I think we can leave it at, let's see then what happens. But thank you so much, Jack. That was really interesting.
Thank you, Joeri. See you.